Hello everyone, welcome to the market opening bell on Monday, June 23rd, your 10-minute guide to the stock market. Last Friday, Hong Kong stocks rebounded with the Hang Seng Index closing at 23,530 points, up 292 points or 1.3% from Thursday, but down 363 points or 1.5% for the week. The H-share index rose 116 points or 1.4% to 8,527 points, also down 1.5% weekly. The Hang Seng Tech Index gained 44 points or 0.8% to 5,133 points, but fell 2% for the week, marking its second consecutive weekly decline. Total market turnover was 222.4 billion Hong Kong dollars. Shanghai and Shenzhen markets were soft last Friday with reduced trading volume. The Shanghai Composite Index closed at 3,359 points, down 3 points and fell 0.5% for the week. The Shenzhen Component Index hit a low of 9,998 points, closing at 10,005 points, down 46 points or 0.5%, with a weekly drop of 1.15%. Combined turnover in Shanghai and Shenzhen was 1.0676 trillion yuan, down 182.9 billion yuan from the previous day. The renminbi central parity rate was set at 7.1695 against the US dollar, a 3-month high, up 34 pips from the prior day. June loan prime rates LPR remained unchanged, with the 1-year LPR at 3% and the 5-year LPR at 3.5%, in line with market expectations. After May's cut, rates are still transmitting to loans, reducing the need for immediate further cuts. Progress in China-US trade talks and low bank net interest margins also factor in. However, room for LPR cuts exists in the second half, especially for the 5-year LPR tied to mortgage rates, as policies to stabilize the property market may intensify, potentially guiding the 5-year LPR lower to further reduce mortgage rates. China's Ministry of Commerce reported that from January to May, 24,018 new foreign invested enterprises were established, up 10.4% year on year. However, actual foreign capital utilized was 358.1 billion yuan, down 13.2% year on year, with the decline widening from 10.9% in the first 4 months, indicating continued foreign capital outflows. Back to the Hong Kong market, the People's Daily published an article titled, "How Can Blind Boxes Be Unrestrained?" noting the rising popularity of blind boxes among children and teens, with frequent irrational spending to chase rare items. It urged stricter regulations to protect minors without naming companies. PopMart fell 3.6% to 239.6 Hong Kong dollars, and Block dropped 9.7%. Media reports also noted PopMart founder Wang Ning revealed plans for a movie and the establishment of a film studio, launching an animated series, La Boo and Friends. Three stocks will debut today. Sanhua Intelligent Controls 2050, a leader in refrigeration appliances and EV thermal management, closed at 21.85 Hong Kong dollars in Philip Mart grey market on Friday, down 3% or 0.68 Hong Kong dollars from its IPO price, with a per lot paper loss of $68, excluding fees. BZ Health Group 2609, a Chinese oncology group, closed at 5.3 Hong Kong dollars, up 25.6% or $1.08, with a per lot paper gain of $648. Transthera Sciences 2617, a biopharma company, closed at 22.2 Hong Kong dollars, up 68.8% or $9.05, with a per lot paper gain of $4,525. US markets reopened after a holiday on Friday with mixed results. Fed Governor Waller signaled a possible rate cut next month, and Trump delayed the decision on attacking Iran. Later updated, see below. The Dow opened up 119 points or 0.3%, peaking at 220 points or 0.5%, and closed at 42,206 points, up 35 points. The S&P 500 opened up 18 points or 0.3%, closing at 5,967 points, down 13 points for its third straight decline. The Nasdaq opened up 93 points or 0.5%, closing at 19,447 points, down 98 points. For the week, the Dow rose 9 points, the S&P 500 fell 9 points, and the Nasdaq gained 40 points. The Nasdaq Golden Dragon China Index closed at 7,126 points, down 65 points or 0.9%. Tech stocks showed mixed performance. Apple rose 2.3%. Tesla set to open its first showroom in India in July, closed flat. Meta and Amazon fell over 1%. The U.S. Senate passed the Stablecoin Genius Act last Tuesday, now under House review. Stablecoin issuer Circle surged 20.4%. The Wall Street Journal reported U.S. Commerce Department officials may revoke exemptions allowing U.S. chip tech into Chinese factories of Samsung, SK Hynix, and TSMC. Chip stocks fell, with Nvidia down 1.2% after 2% drop, and TSMC down nearly 2%. On economic data, the Conference Board's U.S. Leading Economic Index (LEI) fell 0.1% in May to 99 after a revised 1.4% drop in April. The Philadelphia Fed Manufacturing Index was -4 in June, flat from May but below the expected -1, signaling sluggish manufacturing, slowing demand, and worsening labor conditions. Over the weekend, Trump posted on social media that the U.S. struck Iran's Fordow, Natanz, and Isfahan nuclear facilities. Iran warned that U.S. involvement would jeopardize its Middle East interests, but no retaliation has been reported yet. Iran's parliament suggested closing the Strait of Hormuz, though the final decision rests with its Supreme National Security Council. The strait between Oman and Iran connects the Gulf of Oman to the Persian Gulf and handles about a third of global seaborne crude trade. A closure could push oil prices above 120 US dollars per barrel, fueling inflation and impacting markets. Future market reactions hinge on Iran's response or potential strait closure. Our stock pick today is SINOTRUK, stock code 3808. SINOTRUK closely aligns with market demand, continuously expanding into niche markets and optimizing its product structure, achieving industry leadership in multiple segments. In the heavy-duty truck sector, the group has dominated several niche areas of the tractor market. Notably, its 15-liter high-horsepower gas tractor achieved a market share increase of 9.7 percentage points year-over-year in 2024, leading the high-end gas tractor segment. Its container transport tractor market share rose by 3.5 percentage points year-over-year. In the cargo truck market, the group has deepened its penetration into various application scenarios, addressing product weaknesses and focusing on urban express delivery. Its express delivery market share leads the industry, with the wing opening cargo truck market share growing by 3.7 percentage points year-over-year in 2024, ranking first. In the specialized vehicle market, SINOTRUK leverages differentiated competitive advantages and enhances product quality, with its market share increasing by 0.7 percentage points in 2024, maintaining leadership in high-end segments like firefighting, concrete pump trucks, and oilfield operations. In the new energy vehicle market, the group capitalizes on technological strengths, focusing on weight reduction, cost optimization, and energy efficiency, while improving product reliability. New energy heavy-duty truck sales surged 294% year-over-year in 2024, with market share up by 3.7 percentage points, achieving breakthroughs in tractor and times 4 dump truck segments. Internationally, SINOTRUK aggressively expands overseas, reinforcing traditional strongholds and tapping into higher-end markets. Last year, its heavy-duty truck export sales and revenue hit record highs, maintaining its position as China's top heavy-duty truck exporter for 20 consecutive years. As of December 31st, 2024, the group established 80 overseas offices in over 110 countries, developed a network of more than 200 distributors, set up 10 overseas subsidiaries, and built 29 knockdown production plants abroad. This forms a marketing network covering developing countries and emerging economies in Africa, the Middle East, Central and South America, Central Asia, and Southeast Asia, as well as BRICS nations and select mature markets like Australia, Ireland, New Zealand, and Hong Kong. In the light-duty truck sector, SINOTRUK focuses on breakthroughs in niche markets, achieving significant progress across regions. In 2024, its sales grew against market trends, with market share up by 2.68 percentage points, narrowing the gap with competitors. Notably, its stick truck market share rose by 6 percentage points, ranking first, while tow trucks, refrigerated trucks, sanitation trucks, crane trucks, and hazardous material transport trucks also sales breakthroughs. Looking ahead, China's vast commercial vehicle fleet and the gradual implementation of the trade-in policy for National 4 vehicles will create replacement opportunities. As Chinese commercial vehicles gain global competitiveness, international market recognition is expected to grow, coupled with advancements in electrification and intelligent technologies. Commercial vehicle companies will find new business model innovations and structural growth opportunities. Recommended buy price is 21.5 Hong Kong dollars, with initial target at $22.8, followed by $24 and stop loss at $20.5. I do not hold the aforementioned stock.